Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Welcome to the show, Josh. Here's the question investors keep dodging. Is Japan finally normalizing after decades of deflation? Or are we watching the early stages of a policy mistake that spills straight into global markets?
And when you say spills into global markets, you don't mean some academic footnote in Tokyo. You mean yen, JGB yields, carry trades, the plumbing. The stuff that can hit US treasuries, growth stocks, emerging markets, all the places people pretend are disconnected until they're suddenly not.
Exactly. Japan matters because for a very long time, it was the world's cheap money utility. The Bank of Japan suppressed yields, pinned financing costs down, and trained markets to think of Japanese policy as a permanent exception. If that exception is ending, then price signals everywhere have to adjust.
Right. For years, Japan was the guy at the poker table handing out chips at a discount, and now people are acting surprised the game changes when he stops. That's the part I think retail investors miss. They hear Japan and think aging demographics, sleepy economy, sushi, maybe Toyota. They do not think this can change risk appetite in my portfolio.
Which is a mistake. Start with the old regime. A decade, really more than a decade, but especially the last stretch of ultra-loose policy distorted almost everything. Bond yields were not allowed to speak honestly. Capital allocation got lazy. Investors learned that borrowing in yen was cheap, stable, and almost boring. And boring funding becomes dangerous because people lever it precisely when they stop respecting it.
Wait, boring funding. That's good because the carry trade only works when the funding side feels like wallpaper, right? Cheap yen in, higher yielding assets out. If that wallpaper starts peeling, if JGB yields move and the yen stops behaving, then suddenly your low-risk financing looks more like a tripwire.
That's it. And the concrete signs are already the signs that matter most. The yen has not behaved like the old permanently weak funding currency people got used to. And Japanese government bond yields have become more volatile because the market is trying to discover a price after years of administrative suppression. That is a regime shift signal. Not proof of success, but proof that something fundamental changed.
Let me play this back maybe slightly wrong. You're saying the story is not just Japan has some inflation now. The story is that once yields are allowed to move even a little, everybody realizes they forgot how to underwrite a normal Japanese bond market.
Not slightly wrong, mostly right. The bigger issue is that a normal bond market, after years of manipulation, may feel violently abnormal. If you suppress volatility long enough, the return of volatility looks like a crisis, even when it's just price discovery.
And that gets us to inflation, because this is where the story gets messy. Inflation coming back to Japan sounds like victory if all you remember is the country spending years begging for inflation. But inflation has sources. Some are healthy, some are poison.
Correct. Good inflation would mean stronger domestic demand, broadening pricing power, and wages rising enough to validate it. Bad inflation is imported costs, weaker currency effects, energy pass-through, and households paying more without real income keeping up. Central bankers love to blur those because the headline number lets them declare progress. Consumers don't care about the headline. They care whether wages outrun prices.
The distinction between imported cost inflation and wage-backed inflation, that's the whole case, isn't it? Because if a Japanese household is just eating higher food and energy bills, that's not normalization. That's a tax with nicer branding.
Yes, and this is where I get impatient with the cheerleading. Japan can have inflation and still not have escape velocity. A temporary import shock is not the same thing as a durable domestic reflation cycle. To say otherwise is sloppy.
There's dad, red pin out. But on wages, I think the labor story is actually more interesting than the inflation story. Japan's shrinking workforce changes bargaining power. Labor shortages are real. And yet, an aging society doesn't suddenly become a young, dynamic wage machine just because policymakers want a cleaner narrative.
Precisely. Demographics cut both ways. A tighter labor pool can support wage gains, but an aging, shrinking workforce also limits potential growth and complicates any victory lap. It is hard for a central bank to say mission accomplished when the labor engine underneath the economy is still structurally slowing.
That aging labor engine phrase is going to stick with me because it means even if annual wage settlements look better, and that's an indicator investors absolutely should watch, you still have to ask whether this is cyclical improvement or just scarcity in a declining base.
Exactly. And while everyone watches the policy statement, I'd argue the bond market may be telling the truth faster than the central bank. JGBs matter because they reveal how much repression was embedded in the system. Rising yields increase the cost of capital, pressure old positioning, and test how robust Japanese banks, insurers, and leveraged strategies really are under less artificial conditions.
So when a JGB yield rises, the implication is bigger than the bond itself. It says the old carry architecture may not be as safe as people assumed. It says the cost of being cute with leverage just went up.
Yes, and the yen is the pressure valve for all of it. A stronger yen can relieve imported inflation, which sounds healthy, but it can also tighten financial conditions, hit exporters, and force a rethink in global funding trades. A weaker yen helps exporters and earnings translation, but it raises import costs and can undermine real household purchasing power. There is no free lunch here.
I want to push on that. People hear stronger yen and treat it like a clean badge of health. I'm not sure it is. If you've built corporate expectations, export competitiveness, and investor positioning around a weaker currency, then a stronger yen is not a wellness retreat. It's rehab.
Good. Rehab is usually unpleasant because the prior condition was unsound.
There it is. Let's bring in equities because this is where people get tempted to oversimplify. Corporate Japan is not the same company it used to be. Governance reform is real. Shareholder pressure is real. You've seen better capital discipline, more attention to returns, more willingness to do buybacks, less of the old cash hoarding religion. That matters.
It does. Improved governance can absolutely make Japanese equities more investable than they were in the old stagnation era. But let's not confuse micro improvement with macro immunity. Better board behavior does not repeal higher rates, slower trend growth, or currency volatility.
So if a company improves ROE and stops treating the balance sheet like a museum exhibit, that's good, but it doesn't erase the fact that the discount rate may be rising and financing conditions may be less forgiving.
That's correct. Investors love tidy narratives. Japan reforming is tidy. Japan reforming while monetary conditions normalize and old distortions unwind is less tidy, but closer to reality.
Which brings us back to the carry trade. I think this is the hidden fault line. If you borrowed cheaply in yen and bought higher yielding stuff elsewhere, you made the spread look like genius. But if funding costs rise or the yen strengthens into your face, that genius can turn into forced selling fast.
I agree with the mechanism. I'm less convinced every move becomes a disorderly unwind. Markets also have a bad habit of seeing a ghost in every basis point. Not every shift in Japanese policy detonates global risk assets.
Fair, but I'm not saying every move detonates. I'm saying the system is more fragile than it looks because the trade was treated as infrastructure, not speculation. And when speculation dresses up as infrastructure, people oversize it.
That's a valid distinction. The failure mode I worry about is not a dramatic headline panic. It's a grinding repricing. Yen funding less attractive, foreign bond demand less automatic, US assets losing a marginal buyer, carry strategies becoming less profitable, risk appetite thinning around the edges before anyone calls it a crisis.
That marginal buyer point matters because markets don't break only when the biggest buyer disappears. Sometimes they just get a little less supported, a little less liquid, a little less forgiving. That's enough.
And that takes us to the two scenarios. Orderly normalization, wages firm, inflation broadens in a healthy way, the BOJ moves carefully, JGB markets absorb more volatility without cracking, and Japan finally exits the deflationary mindset. That is the optimistic path.
The darker path is higher rates exposing structural weaknesses that cheap money had been covering up. Households squeezed, exporters hit by currency shifts, bond markets jumpier than policymakers expect, global carry positions unwind in chunks. And suddenly, normalization is just another word for removing the scaffolding too fast.
My most plausible failure mode? Policy credibility gets trapped between two errors. If the BOJ moves too slowly, imported inflation and yen weakness keep hurting households. If it moves too quickly, the bond market and leveraged positioning force tighter conditions than intended. That is a narrow path, and central banks are not famous for walking narrow paths well.
Mine's even simpler. Investors keep using the old Japan playbook one quarter too long. They keep assuming suppressed yields, endlessly cheap yen funding, and harmless volatility. And by the time they notice the regime changed, the easy exits are gone.
So what do you actually watch? Wage settlements, not speeches, wages, core inflation persistence, especially whether it looks domestic rather than purely imported. JGB volatility, because the bond market usually sees the stress before the equity market admits it. BOJ communication, not for the theater of it, but for clues about tolerance for market pricing. And the yen, because it links household pain, exporter relief, and global funding conditions in one instrument.
And portfolio-wise, this is not a cartoon buy Japan or short Japan call. It's a reminder to respect second-order effects. If you own US risk assets, you still care about Japanese funding conditions. If you own multinationals, you care about yen translation and global demand. If you're using leverage anywhere, you should care a lot.
That's the point. Japan may not be going back to the old deflationary script, and investors who keep pricing it that way may be the ones caught wrong-footed.
Translation: the boring market might be the one that bites you.
Markets usually prefer victims who call them boring.
That's a good place to leave it. Thanks for listening.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation with a member of our team. Robert, Joshua, Andrea, Mike, or Eugene, and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.